Oh, it's 6:44, 53 seconds, November 4th, 2008. This is my it's tiny.cc/my slides. It's my RSI reversal setups, and the ebook is hosted there at #PUY. And very quickly, we can just go through some setups. God, I did this last year. So just say that my logic is simple. An RSI divergence is a leading indicator for price reversal. So let's try to find a signal at locations where you could anticipate price reversals. And let's do that at the extremes or inside trends, particularly the third test of a trend line. So we'll just skip. You can look at this, and I'll just see. This is like Apple up around 525. You can see higher highs price, lower lows on RSI. That's just a basic classic divergence. And you can see Apple came off. But that's not a location for a possible price reversal. But so it's less probable. Well, I don't have the next slide to show you that Apple came off, but it did. You know, look, we have a day low on a support level. There's a support level. Look, day low, bullish divergence. You know, a day high, bearish divergence, more than 10%. And I just do a subtraction between the first peak and the next peak, the RSI peak, subtracted the RSI value there. You can see it's a simple subtraction. Double divergences are strong signals. Look, when you have price making a lower low, that's 1, 2, you have RSI making higher high, that's the double divergence. It's the strongest signal for a price reversal. I like double bottoms, bullish divergence, but a double divergence and the second half is a double bottom. That's high probability. So it's combining the double bottom with the double divergence. So when it's more than 5%, it has an edge. And I just say that low momentum has RSI in 1 minute charts, high momentum has signals in the 1 and the 5, and fractal just has RSI divergence in 3 or more time frames. And these are all hyperlinks to examples of the strategy. Like, for example, if we click here, it'll show you fractal divergence. Look, it's my TwitDoc upload. It's a great app, SlideRocket. That's where it's hosted. So you can read, you know, my backtest. And I have 2,000 pages of backtests, literally 300 or 400 of them. So the strategies, they go from low probability to high probability. And the whole point of me measuring the difference between the first RSI peak and the second is to quantify the quality of the signal to then say how probable a price reversal is. When it's more than 5%, it's a good leading indicator for a possible price reversal. Now put that signal in the most probable place, and you know, it's not rocket. We're not talking quantum physics or, you know, double integration or, you know, keep it simple. Find an RSI divergence at a day extreme, be it a high or low, then trade the break of the trend line for that move. And it's simple. We have a trend line going up, we have the resistance, and we have a bearish divergence, and then you get short. And then you can see the candle broke, the trend line broke, and we came off. So RSI kept it simple. So here we go. This trend line, double top ends the day, so that's bearish. Then the break of the trend line is bearish. You know, you get short. You see another example. So you got to go through this presentation. It's really good. Here's a video of RSI. Keep it simple. RSI in a horizontal level. It's really simple. You know, trend line where you expect to bounce. Look, bullish divergence. You buy gold, goes up 20 points. You just got to spot it and take it and have a tight stop. It gives a high reward to risk ratio. You know, look, day low in oil. It's a past low. So, you know, support 1. Bullish divergence, that's your reason to buy. I'm trying to explain this to a friend and she's just not getting it. It's like we're talking the Heisenberg uncertainty principle and quantum superposition and the double slit experiment and parallel universes. So lots of examples of slides and their signal. Strategy, okay, look. This provides a high probability way to buy into the weakness or sell into the strength, or basically pick market bottoms and tops. It just combines all the strategies. So caveat, I know this is a bold statement, picking market bottoms and tops. Look, so I showed you the whole thing, but here's what it would look like. You know, you're at a day low, you're on an intraday trendline support, you're on, say, the support 1 pivot. It's the first time RSI has made a bullish divergence. It happens to cross the 30% oversold boundary. The difference between the first peak at time N, that's my convention to name this point. The RSI peak always lines up with the price peak. The completion of the signal is the lower price peak. That's where you expect a possible price reversal. This bullish divergence is a leading indicator for a price reversal because it tells us that between this point and this point, the rate of price change on the way down is slowing down. Before things change direction, they often slow down before they make a reversal. It's a simple, at point A, if there's a signal B, we do C. It's simple logic. Was I patronizing then? I fear that I was. This presentation is for comedy value. Oh, I'm tired. Lots of slides, lots of charts, so many charts. Oh, we can just skip all these. Let's get to something more interesting. Technical analysis is not interesting. Look, for example, intraday trend line, 1, 2, 3, fourth test, a long-term uptrend line, the first bullish divergence, and bop. It's a cluster strategy. It's just lining things up, connecting the dots. There's a trade I took. Intraday downtrend line of gold, 5-minute chart. Long-term daily uptrend line support. Third test where we expect a bounce. Support 1 pivot. 3 levels in the same place. And we go inside $30. I got stopped out and didn't take it long again. Silly me. So the cluster strategy. Are we at a day low or high? Are we on or just below a medium-term trend line? Is there also an intraday trendline support? Is there a horizontal level? Is there a bullish divergence more than 5%? Tick 3 of these boxes, tick 4 of these boxes, and you have yourself a trade. You know, if you take a trade at a day low because of 4 reasons, you have a very good chance of being right and getting on side. It's just multi-indicator setups for high probability trading with reasonable stops that give high reward to risk ratios. Fractal divergence is just a change of buying or selling momentum seen across 3 or more time frames that correspond to the same level. It's a simple idea. I don't have time to explain it. Backtesting. Look, every one of these blue links is a hyperlink to a backtest of a key reversal. Like right here, at a reversal, you know? Right here at the high. Right here at the exact high, there was reversal. There was changes of momentum on the trend line. You know, look at S&P. You could look at all these backtests. It'll be perfectly clear. At the exact high on August 14th, there was a huge reversal pattern. Let's look at it. What could it have been? I'd say it was a bearish reversal, bearish divergence on a horizontal level. Oh God, this is 17 pages. Am I insane? Oh, I don't have time to explain all this. You just got to read it. Oh my God, I'm mad. There's so much work. So you can see each one of those hyperlinks. Oh look, I can see the signal. Here it is, look. Key daily fib level. Medium-term uptrend line support. Down trend line resistance. The first bearish divergence. And what happened? Did we sell off? Well, it did sell off. Now, so look at all those backtests. You can look at some of those hyperlinks. Look at gold. On the exact low, there was a reversal. You know, on this trend line, there was a reversal. You know, at the exact August 22nd, look at the top. I picked the top with my strategy. Did I trade it? Can't remember. Maybe not. Probably not.